They told you it was over. On Friday afternoon, as the closing bell rang across Wall Street, the narrative was set in stone. The talking heads on CNBC, the analysts at Goldman Sachs, the algorithm-driven blogs, they all sang the same chorus. They told you that Friday was the top. They told you the squeeze had failed. They told you to take your meager profits and run before the floor fell out. But markets do not listen to narratives. They listen to orders. And today, Monday morning, the market gave its answer. It wasn't a whisper. It was a scream. Look at your screen. Silver is trading at $69.14. Earlier today, in the pre-market hours when most of the world was sleeping, we hit a high of $69.40. That is a move of nearly $2 since the open. That is a surge of almost 3% in a single trading session. To the uninitiated, 3% might sound small. But in the world of commodities, in the heavy, manipulated markets of precious metals, 3% on a Monday morning without a new war starting is a statistical anomaly. It is a Six Sigma event. This is not normal market behavior. This is not a trade. What we are witnessing is a liquidation. The banks that tried to short the market on Friday, the smart money that bet billions on a collapse, are now trapped in a burning building with the exits welded shut. They are deeply underwater, and right now, they are doing the only thing a drowning entity can do to survive. They are panic buying. They are hitting the market buy button with both hands, desperate to cover their short positions before the price breaches the psychological firewall of $70. Why are they terrified of $70? Because they know what we know. They know that $70 is the event horizon. It is the point of no return. If we break $70, the algorithms that control 80% of global trading volume will switch from sell to aggressive buy. The price enters a vacuum, a zone of zero resistance that goes straight to $75. In this urgent market update, we are going to autopsy the Monday Massacre. We are going to break down the mechanics of this squeeze. We are going to analyze the volume profile to see if this move is genuine or a trap. And we are going to stare directly at that $70 barrier. We are inches away. And the masters of the universe are terrified of what happens when we cross it. This is the story of the day the suppression failed. To understand the violence of this move, you have to rewind the tape. You have to look at how the week started, not in New York, but in the twilight hours of Sunday night when the Asian markets opened. Usually there is a test. The market dips to check for buyers. But last night, there was no hesitation. There was no dip. There was only a gap up. The price jumped immediately, leaving a pocket of empty air on the chart. And then, it did something very specific. Something that veteran technical analysts call a gap and go. Here is the context. Usually when a price gaps up, gravity pulls it back down to fill the gap. It tests the previous close to ensure the foundation is solid. But today, it didn't look back. It opened high, and it traded higher. This is a sign of extreme urgency. It signals that the buyers were not willing to wait for a pullback. They were not willing to haggle over 10 cents. They just wanted in. Ask yourself, who buys like that? Retail investors, the dumb money, usually wait for a dip. They are timid. Hedge funds usually use limit orders to hide their footprints. The only entity that buys with this kind of reckless abandon, ignoring price to secure volume, is a forced buyer. Someone who is receiving a margin call. Someone whose risk manager just walked onto the trading floor, tapped them on the shoulder, and said, "Close the position now, or we will close it for you." This confirms our thesis from the weekend update. The weekend margin call was real. The banks spent the last 48 hours assessing the damage from Friday's close, and this morning, they pulled the plug on the shorts. We are watching a forced liquidation event in real time, and the fuel for this fire is the bank's own money. Let's talk about the high of the day, $69.40. Why did we stop there? Why didn't we teleport straight to $70? Because $70 is a massive psychological wall. Traders call it a big figure. Human beings and the algorithms programmed by them are designed to take profits at round numbers. So as we approached $69.50, the day traders started selling. They wanted to lock in the win. They wanted to secure their bonus. But here is the bullish signal that nobody is talking about. We didn't crash back to 67. We pulled back slightly to 69.14s, and now we are hovering. We are floating just inches below the ceiling. In technical analysis, this is called banging on the door. Imagine a medieval battering ram hitting a castle gate. The first hit weakens it, the wood splinters, the iron bends. We just took the first hit at 69.40. The fact that the price is staying up here, waiting, gathering strength, refusing to retreat, suggests that we are preparing for the second hit. And in financial markets, the second hit is usually the one that breaks the gate. The sellers at $70 are being absorbed. Every time someone sells a contract at $69.90, a buyer steps in and swallows it. Eventually the sellers run out of ammunition. And when there is nobody left to sell at $69.99, the price teleports to $70.10. I want you to visualize what is happening on the trading desks of New York and London right now. Imagine you are a trader at a major bullion bank. Your job is to manage the short book. Your bank has sold millions of ounces of paper silver to hedge funds and industrial clients. You are the market maker. On Friday, you went home thinking you had capped the price at $65. You thought the suppression was holding. Today, the price is $69. You are down $4 on millions of ounces. Your P&L screen is flashing red. It's not just a loss, it's a hemorrhage. Your risk manager is standing behind you, staring at the screen, screaming at you to reduce exposure. What do? Do you double down? Do you short more silver to try and bully the price back down? No, you can't. Your risk limits are maxed out. The computer won't let you sell another ounce. You have to cover. You have to buy back the paper contracts you sold on Friday. But here is the cruelty of the market. Every time you buy to save yourself, you push the price higher. If you buy 500 contracts to stop the bleeding, you push the price to $69.50. This triggers the algorithm at the bank down the street, Bank of America or Scotia, forcing them to panic. So they buy, which pushes the price to $69.60. This is the feedback loop of doom for the shorts. They are trapped in a room with only one exit, and the exit gets smaller every time someone tries to squeeze through it. The rally isn't driven by greed. It is driven by fear. The primal fear of a bank losing control of its own balance sheet. Now, look at the news. Open a new tab. Go to the Wall Street Journal or Bloomberg. Do you see silver soars to $16 as the top story? Probably not. They are talking about the stock market. They are talking about interest rates. They are talking about Nvidia's latest chip. Why? Because a soaring silver price is an embarrassment to the financial establishment. It signals inflation. It signals a loss of confidence in the US dollar. And most importantly, it signals that the smart money is losing. The media blackout is actually the most bullish signal we have. It means we are still in the stealth phase of this move. The herd hasn't stampeded in yet. Grandma isn't calling you asking how to buy coins. Your Uber driver isn't pitching you silver mining stocks. This rally to $69 is being driven entirely by institutional desperation. If we are at $69 without the public, imagine where we go with the public. But there is a variable in this equation that most retail investors ignore. A variable that makes this specific week the most dangerous week of the year for the banks. The calendar. Look at the date. It is December 22nd. It is 3 days before Christmas. In the financial world, this is usually when the lights go out. Trading floors empty out. Volume drops. Volatility disappears. The senior partners go to St. Bart's or Aspen. But this year, the lights are staying on. And the fact that this rally is happening now, during the quietest week of the year, creates a phenomenon known as the holiday liquidity trap. To understand why silver is moving $2 in a day, you have to understand liquidity. Imagine a swimming pool full of water. If you jump in, the water level barely rises. That is a liquid market. It can absorb big orders without moving the price. Now, imagine a bathtub. If you jump in, the water overflows. That is an illiquid market. Usually, the silver market is a swimming pool. But during Christmas week, the swimmers leave. The banks reduce their market-making activity. The hedge funds close their books. The order book, the list of people waiting to buy and sell, gets very thin. Instead of 500 contracts waiting to be sold at $69.50, maybe there are only 50 contracts. So what happens when a whale comes in and buys 500 contracts? In a normal market, the price ticks up 1 cent. In a thin holiday market, they chew through the 50 contracts instantly. Then they hit the next order at $69.60, then $69.70. They chew through the entire ask side of the book in seconds. The price spikes. This is called slippage. And right now, slippage is the best friend of the bull. This brings us to the human element. The psychology of the skeleton crew. Who is manning the trading desks at JP Morgan right now? It isn't the managing director with 30 years of experience. He is skiing. It is the junior trader. The 25-year-old with 2 years of experience who drew the short straw and has to work Christmas week. Put yourself in his shoes. Your boss left you with one instruction. Don't lose money. Keep the book flat until January. Suddenly, silver spikes $2. The red lights start flashing. The value at risk model screams that the bank is losing millions. What does the junior trader do? Does he have the courage to double down? Does he have the authority to short more silver to stop the rally? No, he is terrified of getting fired. So, he does the safe thing. He covers. He buys back the position to stop the pain. He neutralizes the risk. He thinks, I'd rather explain why I closed the trade than explain why I lost 50 million. This is why holiday rallies are so violent. The adults are gone, the kids are scared, and scared traders buy to cover. And there is a technical accelerant pouring gasoline on this fire. Gamma. We are approaching the end of the month. Options expiration is looming. There is a massive wall of call options sitting at the $70 strike price. Market makers, the banks, sold these options. They are short the calls. As the price approaches $69.40, the market maker algorithms, the robots, have to hedge. They have to buy futures contracts to offset the risk of the calls paying out. In a liquid market, they can do this quietly. In a thin market, their buying pushes the price up, which forces them to buy more, which pushes the price up. This is a feedback loop inside a vacuum. The algorithm doesn't know it's Christmas. It just knows it has to buy. We could see silver hit 72 in a matter of minutes if this gamma squeeze gets triggered in a thin order book. It isn't fundamental demand. It is structural fragility. The system is brittle, and $70 is the hammer. If you are just joining us, look at where we stand. The price of silver is trading at $69.14. We have rallied nearly 3% in a single session. We have erased the Friday drop. We have ignored the low-volume warnings. And now, we are staring at the psychological fortress of $70. $70 is not just a number. It is the line that separates the old world, a world of manipulated, suppressed prices, from the new world of price discovery. The banks have spent decades building walls to keep silver contained, first at $30, then at $50. Now, $70 is their last line of defense, their Alamo. Why does the market care so much about $70? Why not $69 to $80? Because human beings are irrational. We are programmed to respect round numbers. In trading, this is called big figure resistance. When a trader sees the price approaching $70, their lizard brain says, that is expensive. That is a good place to sell. Hedge funds place limit sell orders at $69.99 to front-run the wall. Option writers defend the $70 strike price to avoid paying out millions. It becomes a self-fulfilling prophecy. The price hits $69.90, and it bounces off like it hit an electric fence. We saw this today. We hit $69.40 and pulled back. That was the warning shot. The sellers stepped in to defend the castle. But here's the secret of a short squeeze. Round numbers are magnets. Yes, they repel price initially, but if the price keeps coming back, if it keeps knocking, the magnet flips. It starts to pull. If we break $70, even by 1 single cent, it triggers a cascade of stop-loss orders from the bears. Everyone who bet against silver has their eject button set at $70. When those stops trigger, they turn into market buy orders. So the wall of resistance instantly transforms into a wave of buying fuel. This is how you get a blow-off top. The defenders become the fuel for the explosion. Let's look at the long-term chart. Go back to 1980. The high was $50. Go back to 2011. The high was $49. We are currently trading at $69. Do you know what this means? It means there is no price memory. There is nobody alive who bought silver at $75 and is waiting to sell to break even. Those people do not exist. There are no bag holders overhead waiting to dump their supply. When an asset enters a price range it has never seen before, it is called blue sky. In blue sky, technical analysis breaks down. There are no resistance lines. There are no Fibonacci retracements from previous highs. There is only momentum. In this environment, the price can move irrationally fast. It moves until it finds a seller. But if everyone is in profit and everyone thinks it is going higher, who sells? Nobody. So the price has to go to $80 or $90. It has to go high enough to convince the diamond hands to finally let go. There is a subtle but powerful shift that happens when the handle changes. The handle is the first digit of the price. When silver went from $19 to $20, the perception changed. When it went from $49 to $50, the world went crazy. Moving from the 60s to the 70s changes the narrative. To the retail investor, $60 feels like expensive $50. It feels like you missed the boat. But $70 feels like cheap $100. When silver hits $72, the psychological anchor shifts. People stop looking down at where it came from. They start looking up at the triple digits. This pulls in the momentum chasers, the George Soros crowd. This is the principle of reflexivity. Higher prices attract more buyers, which leads to higher prices. Breaking $70 is the signal to the momentum crowd that the trend is accelerating, not ending. It validates the thesis. It turns buying silver is risky into not owning silver is risky. We also have to look at the other side of the trade, the industrial buyer, the procurement manager at Samsung, Tesla, or a solar panel factory in India. They are watching the same screen. They see $69. They see the relentless move up. At what point do they panic? At $60 they were annoyed. At $65 they were concerned. At $70 they are terrified. $70 is the level where budget forecasts break. It is the level where they have to walk into the CFO's office and ask for more money. It is the level where they realize that just-in-time inventory has failed. If we break $70 this week, we will see panic hoarding from the industrial sector. They will stop buying for next month and start buying for next year. They will try to lock in supply before it hits $100. This inventory build pulls massive demand forward. It takes future demand and stuffs it into the present. This is how you get a vertical spike. The industry is not reacting to the price, they are reacting to the trend. And the trend says, buy now or pay double later. So, $70 is the key. The blue sky is open. The industry is panicking. But markets are treacherous, especially in a holiday week with thin liquidity. What happens if we fail at $70? What happens if the banks manage to engineer a double top and smash it back down? And if we do break out, how do you trade it without getting wrecked by the volatility? In part 4, the conclusion of this market alert, I'm going to give you the endgame strategy. I'm going to show you the specific pivot points to watch on the chart. I'm going to explain why using leverage right now is a death sentence. The market is moving fast. You need a plan. We have reached the end of the trading day. The sun is setting on New York. The closing bell is ringing, and the price of silver is standing tall at $69.14. Take a deep breath. Do you realize what just happened? The banks tried to crash the market on Friday. They failed. They tried to scare you out of your position. They failed. And today, on a quiet Monday before the holidays, the market rallied nearly 3%. This is a statement. It is a statement that the path of least resistance is higher. It is a statement that the physical shortage is more powerful than the paper manipulation. But now we have to talk about the hard part. Holding. It is easy to hold when you are losing money. You have no choice. You become an involuntary investor. It is incredibly difficult to hold when you are making money. The temptation to sell, to ring the register, to lock it in, it is overwhelming. In this final chapter, I am going to give you the endgame strategy. I am going to show you the specific price levels, the pivot points, that will tell us if this rally is safe or if it is about to reverse. In trading, we don't guess. We react. We look at key levels on the chart. Right now, there are two numbers that matter. Everything else is noise. Number 1, the ceiling at $70. This is the resistance. If we break $70 with high volume, the trade enters hyperdrive. The shorts capitulate. The media wakes up. The price goes vertical. We want to see a daily close above $70 to confirm the breakout. Number 2, the floor at 67. This is the support. Remember Friday's high? It was 67.14. Technical analysis says that old resistance becomes new support. If the price pulls back tomorrow, we must hold $67. If we bounce off $67, it is healthy. It is a retest. But if we crash below $67, it means today's rally might have been a bull trap. It means the sellers are back in control. So your strategy is simple. Watch $67. As long as we stay above that line, you do nothing. You sit on your hands. You let the profit run. Now, a warning, and this is critical. I know some of you are looking at this chart and thinking, silver is going to the moon. I should buy call options. I should use margin. I should bet the farm. Do not do it. Volatility kills leverage. In a holiday market with thin liquidity, the price can swing $5 in an hour. If you are using leverage, a $5 drop wipes you out. You get a margin call. The bank sells your position at the bottom. And then, 10 minutes later, the price goes back up. You were right about the direction, but you lost all your money because of the volatility. The banks know you are greedy. They will engineer shakeouts specifically to hunt leverage traders. They will drop the price just enough to liquidate the gamblers and then resume the rally. The only way to survive a supercycle is to be unshakable. Physical silver has no leverage. It has no margin call. It sits in your safe. If the price drops $10, you still own the same number of ounces. Play defense first. Protect your position. Don't get greedy. We are entering a peculiar time of year, the Santa Claus rally. Historically, the last week of December is bullish for stocks and commodities. Why? Because the sellers are gone. The short sellers have closed their books for the year. They are on vacation. They don't want to start a fight 3 days before Christmas. This creates a phenomenon called the drift. Prices tend to float higher on low volume. It is like a balloon that has been untethered. Without the weight of the sellers holding it down, it drifts up. We could see silver drift through $70 this week simply because nobody is standing in the way. Do not mistake low volume for weakness. In a shortage, low volume means no sellers, and no sellers means higher prices. Let's zoom out one last time. Where are we in the cycle? We have broken the 6-year consolidation. We have broken the handle of the cup and handle pattern. We have broken the psychological barriers of $30, $50, and $60. We are in the early innings of a historic repricing event. This is not the top. This is the recognition phase. The world is just starting to recognize that silver is essential for energy, essential for tech, and essential for survival. The move to $69 is just the market pricing in the current deficit. It hasn't even started pricing in the future deficit from Samsung batteries or Indian solar panels. So, do not let the fear of heights paralyze you. Yes, $69 feels high compared to $20. But compared to the utility of the metal, compared to the cost of mining, compared to the money supply, it is still cheap. So, here's the plan for the rest of the week. Watch $70. It is the next domino to fall. Respect the volatility. Do not use leverage. Ignore the intraday noise. The low-volume holiday trading will be choppy. Hold the physical. It is the only asset with no counterparty risk. The banks lost control today. They tried to stop the rally, and they were overrun. Now they are on the defensive. They are covering. They are chasing. They are doing exactly what we predicted they would do. You were right. You held. You stacked. You waited. Now, enjoy the show. The Monday Massacre was a victory for the bulls. Let's see what Tuesday brings.